Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Well, we all know diversification is important, but sometimes too much of a good thing can also hurt you. It's not unusual to see 20 or even 30 funds in a portfolio, but that exactly is over-diversification. And today we'll help you find out if your portfolio is too crowded and how you can fix this. But first up, here's a poll, a quick self-check, keep a mental score. Do you have more than 10 funds in your portfolio? Are 2 of the funds from the same category? Did you add a fund in the last 12 months without removing another? Can't remember why you bought each fund? Do many of your funds show similar returns or holdings? Do you have a fund which is barely 0.5% of your portfolio? Well, if your score is anywhere between 0 to 1, you're fine, lean and focused. If you've scored between 2 and 3, time for caution. Review your portfolio. If you've scored anywhere between 4 to 6, your portfolio is overcrowded and likely underperforming. And today's episode is for you. Welcome, Dhirendra.
Thank you.
First up, let's delve into the reasons why people add on to so many funds in their portfolios.
No, variety of reason. In all other walks of life, we buy the new version which is latest, which has added features. So people think that, this is a new fund is better. Then the other thing is, there is a great degree of financial illiteracy around mutual fund. A new fund starts with a NAV of 10 rupee. And people think that NAV is the price of a mutual fund. Lower the price, better it is. All other older funds are more expensive because they have a higher NAV. This is also, because it doesn't matter. 10 rupee or 1,000 rupee or 5,000 rupees NAV, it doesn't make a difference because you are buying at today's prices. But this is a myth which has not been removed. And so this is another. Third is that, when you look at the series of new funds, it is being touted as a great story and it has some selling points, it has some appeal and people buy into it. So investment is being bought or, is made with a story in mind, like a new Friday release cinema. So variety of things. And then the investor psychology, that they think that they need to do something new. They need to do something all the time because that is what we are taught from our childhood, that if you work hard, you will succeed. And they think that if they are investing, choosing a new fund, investing there or, doing some investment, hyperactivity, they're working hard. Whereas what works in investing is that you have to be very careful about it, being choosy, being selective, being boring, and working on the principles and understanding those principles, absorbing it and not getting swayed by the noise. Because this noise is very difficult to ignore. It is nearly impossible to resist the temptation of something about which somebody is painting. And so once in a while, some of these ideas actually work brilliantly. So people might have regret or it might be a missed opportunity. So people get carried by this and that is why they end up being a collector rather than an investor.
But when does diversification actually crosses into excess? Is there a magic number that these are the number of funds that one must own and beyond that it's not going to work?
You have to really strike a balance of manageability, investing for a reason and not diversifying beyond a point. The moment you cross 10, 15, 20 funds, despite doing a diligent, disciplined investing over a long period of time, because of these distractions, because of these noise, because of these actions, because of these, distractions, investors end up having a disoriented or, a disfocused portfolio. Great diversification can be achieved with one fund. Once you cross a basic threshold, maybe diversify in 2 funds so that you are able to de-risk against relative underperformance of one fund manager. Then once you have actually your scale grows substantially, maybe you diversify for style. To begin with, one should start with a blended style, growth and value all in a single fund, and it can well be achieved. Then if you have done this, maybe 2 funds, 3 funds can help investors achieve all the goals. And if you are going to invest in index fund, just invest in one. Maybe, instead of buying a Nifty or a junior Nifty, buy a, Nifty 100. It will get you the same exposure, the same 100 stocks, top 50 as well as the next 50 in a single fund. And if you are looking for a style diversification, maybe choose another one, which is the equally weighted fund, equally weighted index, which will be, the passive, the value version of the same fund. Great diversification, great performance, and great economies will be achieved by having fewer funds. And most importantly, the advantage of having fewer funds is that you are interested in your fund. When you have 10 funds and one accounts for 0.5% or less than 0.5% or just a random 50,000 rupees invested in a fund, which is very regular. Somebody will have an investment of, 10 lakh, 50 lakh, 1 crore or 5 crore, but he will have a long tail. You will have 5,000, 10,000, 25,000 invested in 10 other funds. And that is like when something does very well, it has no impact on your portfolio. Something does very poorly, you don't even attend to it because it is insignificant. Make investing a deliberate act. Do something for a reason. If you are not doing something for a reason, then at least keep it simple.
All right. So like you were saying that there are people who hold funds of the same category, multiple funds of the same category. It's not uncommon to come across that kind of a portfolio. How does that really hurt returns?
You end up just being indexed and incurring the cost of an active fund.
Okay. All right. So does having 20 plus funds in your portfolio reduce risk or only dilute performance?
Depends, what collection you have. If you have 10 flexi-cap fund, that is one thing. If you have random sector fund, thematic fund, then I think, something will be doing well, something will be doing poorly. You end up being, in a very state of unstructured diversification, a randomness there. So and the net is, most of the time investors doing this, investors having a collection of this, it's a result of chasing good performance. Something has done well, you get attracted to it, you invest, and after you invest, it stops doing well. Or it stops doing well a little later after you start investing. And then you get stuck. And then you get stuck with a very, with sometimes deep regret if large amount of money is invested. Or, you simply become cynical about it. You just ignore it. You become, disinterested in that. And this is the result, when you keep doing it. And it is actually distraction from your disciplined approach to investing for a lifetime.
All right. So suppose I have 30 funds in my portfolio and I've realized that this is over-diversification. How should I go about pruning my portfolio? Because I have to consider taxes, exit loads. So should I be selling aggressively or reduce gradually?
If you have a portfolio of 30 mutual funds, go and set up your investment portfolio at Value Research Online and do a sorting on the overview tab. That what is the percentage in each investment. Anything which is less than 5%, keep an eye on that. If it is not a 5-star, 4-star or 3-star fund, sell it. It's insignificant. You may not be sitting on large gain. And just be conscious of what will be the gain on your investment. I would like somebody to consolidate his investment into 5-star and 4-star funds which are flexi-cap, multi-cap, value fund, because these funds have the flexibility of investing or large and mid-cap fund, because they will be mainstream fund. They can change color. The fund manager has all the flexibility to change his complexion depending on the market dynamics. And one should be in such funds, and substantially in those funds. 60-70% of your money should be in some such fund, and 2-3 of those funds will actually do the job. Rest of it, make sure that you don't have anything which is less than 5%. And if you have a sector fund or a thematic fund, and if you are sitting on gains and you are still very optimistic about the outlook of that category, hold it. Maybe if you are extremely upbeat about something, have 10%, have 15%, but don't let it drift, because what happens is, investors end up having a collection and then something does well, something does poorly, and you just carry on and you end up being an average.
Can over-diversification happen in debt funds as well?
over-diversification can happen anywhere. You can invest and forget and don't take notice. And because open-end funds, unlike bonds, they don't expire. When you invest in a company stock or when you invest in an open-end fund, they are there for perpetuity. Unless there is some winding up going on, you will not get your money back and the money is at work. Now, you better make sure that it is in a performing thing. It is by your choice. You really need it. If you are in a debt fund, yes, in debt, there are a lot of fixed income investors. They don't invest in equity. Their substantial part is in fixed income. And we have seen proliferation of variety of debt funds. And they were also initially sold as a story. But I think, we don't find that kind of fragmentation of portfolio across, or that kind of spread across debt funds.
Right.
Of late.
Okay. Now, one last question. For someone starting afresh, what would a clean, simple portfolio structure be that covers all bases without becoming unwieldy?
This is, a very tricky question because it depends for different individuals. If you're getting started and you are 25-year-old and you are investing, you are saving a fourth of your income and you are starting with a new fund, I would say that start with an aggressive hybrid fund. If you understand the ups and downs of the market, you want to take risk, maybe start with a small cap fund and maybe choose one or two small cap, mid cap fund. You understand the risk, but don't go beyond one or two. Or invest in a flexi cap fund. But make sure that you're choosing a good fund and you're just keeping it to one or two. Only when it becomes a very sizable amount, it is something like, 5 years of your income or 10 years of your saving, that you should think in terms of diversifying over style. You should have some value. Maybe 3 or 4 funds, and all these funds should be accumulated through SIP over a period of time. And resist your temptation to spread your money. Buy into that this is doing well, because over any time period, something else will be doing much better.
So know what you're invested in, diversify but avoid duplication, prune with a plan, and review your portfolio maybe once a year. Now, moving on to the viewer's question. This person says he has an 8-year-old daughter and wants to invest 10 lakh rupees as a lump sum for 10 years so that she can start an SWP from it later. So which fund would you suggest for this purpose?
8-year-old daughter, assuming that this money is going to remain invested for 10 to 12 years for the graduation or, for education, I would still urge that this is a lump sum, but spread this money over next 8 to 12 months so that you eliminate the possibility of investing at a high or being disappointed, or, this is a very turbulent market. We are witnessing a steady decline for past couple of months. So maybe spread it over the next 8 to 12 months. Choose 1 or 2 flexi cap fund and just be at it.
All right. So if your portfolio feels more complicated than your life, it's time to simplify things. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.